Welcome to Tax Dosti channel. Today, we're exploring a Supreme Court judgment from Pakistan that explains important differences between a tax credit and a tax exemption. We'll break it down step by step so that anyone can understand it. Imagine two companies, Nishat Dairy and H Extraction Ghee and Oil Industries. Nishat Dairy imports livestock and supplies to run its dairy farm. H Extraction imports raw materials to produce cooking oil. Both companies have invested in new ventures and are entitled to a 100% tax credit under a section of Pakistan's income tax ordinance called Section 65D. But here's where it gets interesting. These companies wanted to avoid paying taxes on their imports up front. To do this, they needed an exemption certificate. This would allow them to bypass paying advance income tax on their imports. Now here's the legal question. Can a tax credit be treated the same as a tax exemption? Let's explain this with an example. Imagine you're running a business. You have to pay a tax at the end of the year based on your income. A tax exemption works like this. It reduces the amount of income that will be taxed. For example, if you make $10,000 and have an exemption for $2,000, you'll only pay tax on $8,000. A tax credit works differently. Let's say your tax is calculated at $1,000, but you have a credit for $1,000. That means you still calculate the full tax, but the credit cancels out the amount you owe. The companies argued that since they were entitled to a 100% tax credit, they shouldn't have to pay advance income tax on their imports at all. They claimed that a tax credit should be treated just like a tax exemption, which would mean they wouldn't have to pay advance tax on imports under Section 148 of the Income Tax Ordinance. The case was first heard in two different high courts. The Lahore High Court sided with Nishat Dairy, agreeing that a tax credit and a tax exemption were essentially the same thing. But the Islamabad High Court disagreed. They ruled that a tax credit is not the same as a tax exemption. The Federal Board of Revenue, which collects taxes, argued that companies should still pay advance taxes and claim their tax credits later. The case was taken to the Supreme Court of Pakistan. The court had to decide whether a tax credit under Section 65D could be treated like a tax exemption under Section 159. Here's what the Supreme Court decided. Tax credit and tax exemption are different. A tax credit reduces the tax payable after the tax is calculated, while an exemption reduces the income that is taxed in the first place. Because of this difference, companies like Nishat Dairy and H Extraction still had to pay the advance tax on their imports, even if they were entitled to a 100% tax credit. The court explained it in three simple stages. First, there's a declaration of how much tax you owe. Second, you calculate the exact tax based on your income. Third, you pay the tax or claim credits. The court ruled that exemptions apply between stages 1 and 2. They prevent tax from being calculated in the first place. But tax credits apply only between stages 2 and 3. They reduce what you actually have to pay, but only after your tax is calculated. So these companies had to go through the tax calculation process and couldn't skip the advance tax. This ruling is important for businesses in Pakistan because it sets a clear rule. Even if a company is entitled to a tax credit, it still needs to pay advance taxes on imports. The tax credit can be used later to offset what they owe, but they can't avoid paying upfront. Let's say you're running a business and importing raw materials to produce a product. You have a 100% tax credit, but when you import the materials, the government still collects an advance tax on the shipment. Once the tax year ends and you file your returns, that advance tax is deducted from the taxes you owe, or refunded if you owe nothing. But you can't avoid paying the advance tax when you import. This judgment clarifies a critical distinction in tax law for businesses operating in Pakistan. Even if a company enjoys a full tax credit for a few years, that doesn't mean they can skip advance tax on imports. They must follow the process, and any refunds or reductions will be handled at the end of the tax year. This judgment received attention in the business community because it affects how companies plan their cash flow, especially those importing large amounts of raw materials. By setting this clear legal precedent, the court has made it easier for the tax authorities to enforce the advanced tax system, while ensuring businesses can claim their credits at the right time. In conclusion, the Supreme Court has clarified that tax credits and tax exemptions are different, and companies must comply with paying advance taxes. This judgment ensures that tax procedures are followed correctly while allowing businesses to enjoy the benefits of tax credits after proper assessment. If you're a business owner or a tax professional, make sure you understand the difference between tax credits and exemptions and plan your tax payments accordingly. Thank you for watching and subscribing to Tax Dosti channel. Subscribe for more insights into legal judgments and tax laws.